Hi, Luca. Thank you for joining us. It's great to have you back. We've really crossed the chasm with stablecoins and the fundamental role that they play in the global finance system. I'm very honored to have you today. Luca is not only a founder, but a thought leader in this space. So before we dive in, Luca, can you just introduce yourself and briefly share with us the thesis that inspired you to build M0?
Yeah, first of all, thanks again for having me. And it's always a pleasure, and I hope I'm not going to be too repetitive on the things that I believe in, but I think they haven't changed much. But a very short introduction about myself and why I decided to build in this space. I've been a financial institution specialist all my life, for 15, 20 years, working with investment banking and private equity investing in financial institutions. And what inspired me to start building in the crypto and stablecoin space was the conviction that there was really a reimagination of the primitives and fundamental rails for the creation and the movement of money. So for me, stablecoins were not only a payment tool to trade the crypto assets, but were actually a new backend for the entire financial system. And this is what inspired me to found M0. M0 is a stablecoin infrastructure company. And when we talk about infrastructure, we do not work at the connection between the banking world, the fiat world, and the crypto world, but we are building smart contract infrastructures to create money, program money, move it around, make it liquid, and connect all the applications and the agents that use digital money. It's been a crazy journey over the last 3 years. 3 years ago, we started, nobody really understood what we wanted to do, but now it's becoming very, very clear that, first of all, stablecoins are a global phenomenon, but also that the traditional financial system is merging with the digital system, and stablecoins are becoming a very, very important primitives for new financial products to be built on top, or new economic activities or economic agents to interact with each other. So it's very, very exciting times.
Mm-hmm. Yeah, just to add on to that, one of the key principles that you consistently echo is that stablecoins is not a narrow product. It's a complex piece of infrastructure. And so you mentioned a bit about the primitives. Like, what are the next wave of use cases and primitives that you actually see stablecoins powering beyond payments and remittance?
I think we are already seeing it.
Mm-hmm.
I think that if we go back in the history of stablecoins, we had a first phase where I don't know how people are familiar what was the beginning of the stablecoins world, of the tether phenomenon, but it was an interesting phenomenon because individuals wanted to trade crypto assets, and when they wanted to sell crypto assets, they needed to sell the assets and go back in the fiat world to have the cash and then to reinvest in crypto assets back and forth. You want to trade Bitcoin and then you want to sell and buy Bitcoin. So instead of going back and forth between fiat and crypto, the idea was like, why we don't create a proxy dollar so that you can sell a crypto asset for another crypto asset. It's just this other crypto asset is very stable and gives you the ability to actually go risk on, risk off for trading without going back into the fiat world. So the beginning of stablecoins were a very, very small product for trading rebalancing. And then in the second phase of stablecoin, people realize, oh, wow, this is not only useful for trading rebalancing, but it's actually giving the opportunity to everyone in the world to hold a dollar, even if they don't have a bank account. So the second phase of the stablecoin his story was like a global asset to dollars with an alternative fully digital rails on blockchains. And that's what brought Tether from $200 million to like $50 billion. And the following phase was like when institutions realized that, okay, we can actually use this token to actually move in bulk from one fiat system to another fiat system without going through correspondent banking for remittances. And that's where the orchestrators started to get built, like the bridges of the BVNKs of this world. So like they were using stable coins in the so-called stablecoin sandwich, where you're going from a banking system, I don't know, in Indonesia to a banking system in Brazil, and you're actually using a stable coin in the middle. We are already in the following phase. Last year, we already entered the following phase where people like builders started to realize you can actually build more sophisticated experiences on stablecoins. So we started seeing the emergence of stablecoin-powered credit cards, stablecoin-powered current accounts, stablecoin-powered neobank experience. So you have companies like EtherFi, like Cast, like ReadOpay that create some sort of almost banking experience for the user that sees an app with a balance and a set of products they can use, a credit card that they can swipe, etc., which is entirely powered by stablecoins. The stablecoin is the backend of those neo-banking experience. And we are just going along the journey. So like stablecoins as an infrastructure layer is eating one piece of finance, one piece at a time. So like now we're starting to see all this neo-banking experience expanding, becoming more sophisticated, entering into business banking. And you see like other like traditional PSPs, like large remittance or like large fintechs like Klarna, like Ramp, like Stripe, of course, like Meta and many others saying, okay, we are actually going to build on this stack. So I think it's a relentless walk where more and more products start becoming digital. Some incumbents are actually trying to change their business to become digital. It's difficult, but more and more new players, they are born digital, because today you can create a neobank experience for your customers, global from day one, entirely wallet-centric, entirely built on stable coins, where your clients are abstracted away from complexity, but they have a bank account, they have a deposit account, they have an investment account, they have a credit card in dollars. So the next phase is going to be doing the same in any other currency. And we're already starting to see this. So it's not only going horizontal, it's vertical, it's also going horizontal. And you see Brazilian reais, Mexican pesos, Indian rupees, euros, all thinking about building the same stack. So a lot of work and very exciting times. At the same time, we see also regulation evolving. So I spend a lot of time in the US. In the US, we are seeing much more clarity from the regulator, one step at a time, to actually give fintechs the power to do so, bypassing the traditional banking system. So it's exciting that all the things that we actually had anticipated 3 years ago, 5 years ago, are actually materializing one at a time. So this makes me happy as a researcher. Now, as a business person, I need to make sure, of course, that I capitalize on those opportunities instead of others, right?
I want to circle back to that topic in a bit, but before going there, I want to talk a bit about the structure of M0 protocol. So you have designed a foundation that facilitates the bifurcation of money into upstream money. So that's the issuance portion, and downstream money, the distribution layer. Why do you think this modularity approach is critical for the growth and future of stablecoins? And what does that modularity unlock that Tether or USDC cannot address?
Yeah, so I think so answering two parts. The first one is we created we are building, because we started with one protocol, and now obviously this protocol is evolving, it's becoming something more complex because the market is becoming more complex. But we are creating a middle layer that connects upstream and downstream, as you mentioned, because we think these are two completely different markets. I'll be very specific in my example. If you are a fintech or tech builder and you're creating a cool product, whatever that is, It's a rewards card, it's a credit card, it's an account, it's a banking experience, it's a payment tool, it's a crypto trading product. This is your expertise. Your expertise is in product creation and distribution. Your expertise is not in reserve management, issuance licensing, and what a custodian bank would do. And this has been evident, right? Like we have like so many of those builders in the crypto space, they either try to invent themselves banks in an unsophisticated way, or they were looking for partners to do this for them. Now, on the other side, and these builders, they know this very well already. On the other side, you have the banks and traditional financial institutions. They are starting to come into the stablecoin space, but their mental model originally was, okay, I don't know, like JP Morgan. If a company that nobody knows called Tether has 150, $200 billion of reserves, if I create a JP Morgan version of Tether, I will have $2 trillion of reserves. And just because I'm a bank. And obviously, this is not a good mental model, because a bank is not great in distributing and creating a tech products that their customers love, but they are very good in being a bank. So what we actually have created is a system where on the side of the builders, of the tech builders, they can connect and launch their stable coins immediately, make them liquid, interoperable, and programmable, only dealing with code. On the other side, those that are actually working on the custody, on the licensing, on the creation of the token from a regulatory perspective are the financial institutions, and we are in the middle. So we are actually letting these two worlds talk in a way that is digital based. So I am a builder. I create my stable coins using the M0 infrastructure. If I don't want, I don't even know who is actually custodying things behind the scenes. There are banks that are actually doing the issuance and the custody. If I want to work with a specific financial institution, I can, still using the infrastructure that M0 is providing, that is very standardized. Now, what this solves that Tether and Circle does not have, I will have a different question, a different answer is, I think the Tether business is one of the greatest businesses ever. It's not repeatable. They are very, very good. They work incredibly well on distribution. They control distribution. That's what they retain most of the fees. But it's a very specific market. It's an offshore, retail-oriented, emerging market. Circle is a bit different, right? Because Circle is not really controlling their distribution. And if you look at their economics, they are leaving a lot on the table to their main distributors, the main one being Coinbase. So there is already a split between distribution and production that is contractual. I think what is happening, though, is that Circle and Tether, they represent $300 billion, give or take. I think the stablecoin market cap or like size of float will be, I don't know, $5 trillion in the next 10 years. What the rest of the people are going to do, it doesn't really make sense for every issuer in this space to create their own vertically separate offering. So we think that what we provide for all those is a shared network where they can have network effects in creating versions of money that are interoperable, they smell the same, and they are fully integratable with the rest of the world. And that's what we're betting, and we're already seeing it. So if you look at on the issuer side, so the financial institutions that actually create the stable coins, I would say like 80% of the non-USDC and USDT issuers in the US are using M0 infrastructure already. So Bridge Stripe is an issuer on M0 infrastructure. MoonPay is an issuer of M0 infrastructure. OneMoney is an issuer of M0 infrastructure. Anchorage is an issuer of M0 infrastructure. So they already see the benefit of using shared technology. And we think this is just going to grow more and more and more. But it's just the beginning. So we will see a lot of people coming in the market, a lot of financial institutions that financial institutions have the bias of building stuff themselves first, typically failing and realizing that they need to build on somebody else's stack. And probably this is going to happen as well.
Mm. So you talked a bit about, that wallet-centric world, right? Um, and you mentioned previously that like there's going to be an entire generation of people under 30 that like never step foot in a bank branch, right? If issuing stablecoin is like the commoditized like back end business, like in that wallet-centric world, can you share what you see the end user like experiencing, in the next 3 to 5 years?
I think um, I um, I think the end user will have I think it's going to be a continuation for the end user, for most end users. So in the same way you have seen large fintech players emerging very fast, like Robinhood in wealth management or Revolut in banking, etc. This is gonna become more and more prevalent. There are gonna be a lot more neobanks that are emerging everywhere in the world. They're gonna provide very competitive and very cheap banking experiences to users around the world. And I think that we're already seeing it. I think that there's going to be a next crop of Robinhoods and Revoluts or new banks that are being created now on digital rails, and they will grow and they will emerge much, much faster. Like companies I mentioned you before, like the Redo-Pays, the Cast, the EtherFis were founded 2 years ago. And now they're already companies that are worth many billions of dollars. It's taking them 5 times. It's taking them 5 times faster what it took Revolut to go to the same places. And I think I consider Revolut one probably the greatest success stories in the new banking experiences. So I think that what we are seeing is that we are seeing on the banking side, faster product creation and innovation for the users, and expansion of products because the user can have simpler access to better products, earner products, and in a way that is also way cheaper to build. So the builders of this, if you had to build, and if it costed you $1 billion to build a neobank 10 years ago, now it's probably going to cost you $50 million to build it because it's so much cheaper. And there is more and more products that will be created. We now start seeing the entire capital markets moving into a tokenized world, as we have seen, right? So like there is going to be a lot more choice for the users. But at the same time, this is for people that already have access to global banking. So what is going to be the difference for an American user, a European user, or a user from like the main Asian markets? Obviously, this is not 100% of the world. This is probably 30% of the world by population. So for the rest of the world, I think that there is going to be an incredible change because they will have access to global rails and global currencies and global financial systems from day one they didn't have access to. If you look at the Latin American space, if you look at the African space, this is completely new to them. They didn't have access to a dollar account. They didn't have access to a dollar savings account. It costed them an incredible amount of money to move money around the world. And now this is very, very different. Now there is another layer though, that is because I always think that we try to project the future based on the present, and we're trying to extrapolate. It's a bit like when you're looking at science fiction movies done in the 70s and 80s, and everybody in the future is dressed like the 70s and 80s. So it's just like a different flavor. I think there is a new crop of economy that is emerging, which is obviously agent-centric. And this agent-centric economy is not going to transact on banking rails. They will transact on digital rails. So the AI-powered economy, without being too stereotypical, will exist natively on digital rails, and they will do things that are not necessarily a different user experience. Is happening behind the scenes, and this is going to get more and more of a. So a user will probably interact with an agent through like an interface, and then the agent will do financial interactions using blockchain to close transactions. And I think this is what is already happening and what is going to happen in the next 5 to 10 years.
Yeah. Yeah, I just wanted to touch on that. Yeah, the AI agent economy. How are you preparing for that world where there are multiple specialized stable coins and like the financial transactions are, obviously handled by the agents? Yeah.
This is, for people like us, is great because we
Mm,
are building infra. So we want to build the best possible infrastructure that is the most efficient infrastructure, is the most interoperable infrastructure. Now, in a world where the retail distribution is controlling, obviously, if you're great at distribution for humans, humans are lazy, humans love brands, and so there is a way for a distributor to absorb a larger portion of the market of the market surplus and the margin. Now, if the user is an optimizer, is a super optimizer agent, obviously they would like to use the best possible infrastructure. So we're very happy that our client is becoming a hyper competitive and hyper rational agent instead of a human being that is obviously prone to heuristics like all of us and it's taking a way longer to innovate. As always, it's going to be a combination of the two things. There are It's very early. Like, when we talk about agentic economy, it's so early. I still think that the way we're projecting the future is not going to be the future. We're thinking that we have an agent that is going to buy our flights. I don't think this is how it's going to work. I think that there is probably going to be uh, data analytics and data traffic that is overlaid but with some sort of financial services layer, and there are companies like it's public that Cloudflare is thinking deeply about creating a stable coin and a chain for transactions. So it's very, very early. But I think the concept of money is going to change. Like, if you think about it, like, we always think of money as money at rest and money in transit. You have money at rest in a deposit and money in transit payment, because that's how we operate. Like, we are not like, we keep money in a place and we move it somewhere else. In a world where there are like agents that move money continuously to optimize it, to optimize the yield, to optimize the return, to optimize the capital absorption, first of all, there is no more difference between money at rest and money in transit. And secondly, you need to have rails that are able to actually continue move money around instead of being stuck in silos, like as we are used to. And obviously, there's nothing else compared to blockchain rails that can do it today. So we are observing, but it's very, very early. Everything is early in the stablecoin space. We've been talking a lot about it, but most of the things we talk about are not real yet. But when they're going to be real, they're going to be gigantic. So I think that we're all getting ready for that.
Yeah. But it's undoubtedly the right PM fit for, stable coins and the agent economy. You mentioned a bit about regulatory clarity. Last week, I think the latest Clarity Act hearing outlined stablecoin yield compromise, banning passive like yield. Um, M0's model is built around democratizing yield from T-bill collateral. So, what do you think are the implications to your protocol and the broader stablecoin DeFi industry with a development like that?
So first of all, I wasn't surprised because I think that yield always finds a way. And if you limit it in a way, it's gonna try to enter somewhere else because the market is efficient. And as much as banks were trying to control it because they think that the stablecoin market, the product is so competitive that they need to make it non-competitive by limiting the distribution of the economics, there is always gonna be a way. Now, when it comes to yield distribution, what we do at M0 is we want the calculation and attribution of the yield to be done on chain, and we want the distribution of this yield downstream to be programmatic. So for us, it doesn't matter. Like, we have an infrastructure that can do continuous streaming of yield to stablecoin holders, can do batched distribution, partial distributions, distribution based on actions, distribution based on geolocation. So if when Clarity is saying, okay, the Clarity Act is saying, the regulation is saying there needs to be an action to actually enact the yield.
Mm.
I mean, that's what we can do already, but it's very simple, right? Like you can have in the same way you can have an account and you can have a deposit account and you can have a savings account. And when you move money into a savings account, users can earn a yield. Still, you can see how, I mean, unnecessary this step is. Like, if you, again, going back to if you have an agent, an agent can actually move money from an account to the other on a continuum basis. So
Mm.
what's the difference? I think if this is a bit looking in the past.
Mm.
So I think that I wrote a bit about yield and lending markets yield in the past. I am happy that the regulators are becoming more pragmatic on yield distribution because
Mm.
otherwise, as I was mentioning before, yield always finds a way, but it finds a way in a riskier with riskier
Mm.
routes.
Mm.
And so in order to capture some yield on their deposits, the retail is will take more risk. Currently, retail that has a lot of stable coins because they cannot receive yield, they pledge stable coins as deposits in over collateralized lending markets that are exposed to collateral risk, market risk, technology risk. We have seen a month ago, I don't know if the audience is familiar, but like, there was a hack in a large protocol that had a massive impact across the globe, the crypto lending markets. So uh, I think that interestingly, the limitations on yield, uh, when they were very strict, they were not done to protect the consumer. They were done to protect the banking institutions. I don't like personally regulation that does not protect the consumer, is actually
Mm.
protecting businesses. And nobody likes it either. So I think it was a natural step. So we are ready for that. We are super modular. I haven't spent too much time thinking about this yield saga because I was quite convinced that we would have found a pragmatic way. Otherwise, the market would have found another way. But
Mm.
we are still very rigid. I think we still need to understand that the market, the financial service we are facing in the next decades is going to be way more fluid than what we're
Mm.
thinking it is today.
Uh, I I think that you are probably one of the people in the industry that have thought, the hardest about how a money system works and how they also break. What are some of the vulnerabilities or weaknesses in the traditional monetary stack that you think a stablecoin system should avoid? Or like how do you see M0 protocol potentially addressing these vulnerabilities?
I mean, first of all, the fiat system is not the same everywhere, right? So if
Mhm.
if you are in some like developed economies, you are exposed to a fiat system that is way more stable compared to other economies. And there are economies where the local citizens, they are desperately trying to get out of their fiat system because they know they're exposed to hyperinflation and to fraction, so fragmentation, etc. So I think it's difficult to say. Like, it's definitely the systemic advantage for a US business, European business, Singaporean business, or an African business, or like or Japanese business is very different. Um, I think the digital revolution can allow all the systems to actually become all more efficient and going towards like global efficiency.
Mm.
Um, at the same time, it is just like an antiquated business and very limited and very cost inefficient. So uh, it's a bit like at the beginning of the cars, like Henry Ford saying, if I would ask my consumers what they want, they would ask me, they want a faster horse. Like, like these are like it's old tech. So anything you need to build on top of it is just it's hard. It's hard. Like, if the way if you wanna create a product on top of a custodian institution is very complicated. So we're just like bringing the financial system into the 21st and 22nd century. And if we do that, like obviously there is a lot of innovation you can build on top, right? I think that it's just taking a bit of time for us to absorb it. Like I always like thinking analogies, but like the internet. If you look at the beginning of the internet, the New York Times, the first website of the New York Times was a digital copy of the New York Times paper on the internet. That's the way people were thinking about it. It's like, okay, it's a great distribution channel to sell my newspapers to people that can see, they can read it from home. Now, fast forward 20 years, like the newspaper business doesn't exist anymore, and we have like social media, and the way we distribute information, the way we interact with information is completely different because the technology stack is different. And I think the same is going to happen to finance. People will start thinking of having a bank account and a credit card that is powered by stable coins, but a card and the plastic is exactly the same. In 20 years' time, will probably be 100% different, but it's going to be facilitated by a new tech rail that wasn't existing 20 years ago. It just takes some time. We humans, we are very slow with our heuristics and how we do things and how we use technology, even when we have new technology. So it's difficult to extrapolate. I think that the financial system today, it works reasonably well with very strong limitations and is not ready for a digitally native world. It is not. That's why we have the information industry that is working at a completely different speed than the financial industry that is still stuck like 50 years ago. If you go in a bank, probably banks still operate like they used to operate 25, 30 years ago.
Our 30 minutes went by so fast. But thank you so much, Luca. Like maybe for like our final question, like what's next for M0? You know, you've done so many things. Bridge and MetaMask, Anchorage, yeah.
Yeah, I mean, we just keep building. I think that we started when there was no regulation, there was no vision, there was no clarity in the vision with a very ossified protocol. Our infrastructure is becoming more modular, is becoming more institutional ready. We do more things, we integrate more, we work on other sides, not only on issuance, on liquidity, on movements of money, and we do more and more of the same. I think that the company is growing, the type of stablecoin issuance we're facilitating is accelerating, our use cases are growing, the infrastructure that we are building is going to mature, the institutions that are using our infrastructure are changing, the TAM is expanding. It's going to be more of the same for next couple of decades. So the company is also growing, and managing a company. We always talk about the business in the future, but as a CEO, like managing a company absorbs a significant portion of my time as well. So that's what we're doing as well. But we couldn't be more excited to build in this space. We are at the right time in the right place, and it always feels very special when this happens.
Thank you so much, Luca. It's been a pleasure.
Thank you.